Buying Bitcoin in 2026 is easier than ever. You no longer need to start with a crypto exchange, move coins around, set up a digital wallet, or worry about private keys just to get exposure. Now, many investors can simply open a normal brokerage account, type in a ticker, and buy a Bitcoin ETF. And one of the biggest names in that space is IBIT. But here's the important question. Did buying Bitcoin get easier? Yes. But did it get safer? That is a very different question. IBIT can make Bitcoin much easier for beginners to access, but it does not remove Bitcoin's volatility, risk, or emotional pressure. So in this video, we are going to break down what IBIT is, how it works, how it compares with buying Bitcoin directly, what risks still remain, and who should actually consider using it. Because IBIT makes Bitcoin easier to buy, it does not make Bitcoin less risky. IBIT is the iShares Bitcoin Trust ETF. In simple terms, it is an exchange-traded product designed to give investors exposure to the price of Bitcoin. Instead of buying Bitcoin directly through a crypto exchange, a beginner can buy shares of IBIT through a traditional brokerage account. That is the main appeal. It looks and feels more familiar to investors who already buy stocks, ETFs, index funds, or retirement investments. IBIT also has a sponsor fee of 0.25%, but investors need to understand what IBIT is not. IBIT is not a stock. It is not a broad crypto ETF. It is not a diversified portfolio. It does not hold a basket of different assets. It is simple access to Bitcoin exposure, and that means if Bitcoin moves sharply, IBIT can move sharply too. So before anyone treats it like a normal ETF, we need to understand why IBIT became so important in the first place. Before spot Bitcoin ETFs became available, buying Bitcoin could feel intimidating for beginners. You often needed a crypto exchange, a digital wallet, private keys, seed phrases, transfers, and some understanding of self-custody. For experienced crypto users, that control can be valuable. But for beginners, it can feel confusing and risky. IBIT changed the access problem. Now, investors can get Bitcoin exposure with a simple ticker inside a brokerage account. That can reduce operational friction. It can make tax reporting and portfolio tracking feel more familiar. And it can make Bitcoin easier to include alongside stocks, ETFs, and other investments. But easier access creates a new risk. When something becomes easier to buy, it also becomes easier to buy too much. And that is why the hard part of Bitcoin is not always buying it. Sometimes the hard part is surviving the volatility. To see why, let's look at how IBIT actually works. Here is a simple version of how IBIT works. An investor buys shares of IBIT through a brokerage account. The trust is designed to reflect the price performance of Bitcoin, so if Bitcoin rises, IBIT is expected to benefit. If Bitcoin falls, IBIT is expected to fall too. The investor does not personally hold Bitcoin in a wallet. They do not manage private keys. They do not move Bitcoin on-chain. They do not need to worry about sending coins to the wrong address. That convenience is a major reason beginners may prefer IBIT. But convenience comes with a trade-off. When you buy IBIT, you are getting Bitcoin price exposure through a trust structure. You are not directly controlling Bitcoin yourself. So IBIT trades convenience for direct control. And that brings us to the most important beginner comparison, IBIT versus buying Bitcoin directly. IBIT and direct Bitcoin ownership give exposure to Bitcoin, but the experience is different. With IBIT, you get brokerage access, no private keys, no seed phrases, no wallet management, and a more familiar investment format. But you also pay an annual sponsor fee, you trade during market hours, and you do not use Bitcoin directly on-chain. With direct Bitcoin, you may have more control. You can self-custody, you can move Bitcoin on-chain, and you can hold the asset directly. But direct ownership comes with technical responsibility. If you lose access to your wallet, make a transfer mistake, or mishandle private keys, the consequences can be serious. So the better choice depends on the investor. IBIT is easier. Direct Bitcoin gives more control. And once beginners understand that trade-off, the next question is how IBIT compares with other Bitcoin ETFs. IBIT is not the only spot Bitcoin ETF investors can look at. There are other Bitcoin ETFs, such as FBTC, ARTB, BITB, GBTC, and others. For beginners, the mistake is choosing only based on the name that feels most famous. A better comparison looks at costs, liquidity, spread, assets under management, custody structure, tracking, and broker availability. Fees matter because they reduce returns over time. Liquidity and spreads matter because they affect how efficiently investors can buy and sell. Tracking matters because the ETF should closely reflect Bitcoin's price exposure. And trust matters because investors need to understand the structure they are using. For many beginners, IBIT may be one of the simplest and most visible options, but the best Bitcoin ETF is not just the famous one. It is the one that fits your cost, liquidity, trust, and portfolio needs. Now let's get very practical. What problem does IBIT actually solve for beginners? IBIT solves the access problem. It makes Bitcoin exposure easier to buy. It reduces custody friction. It removes the need for beginners to manage private keys. It allows investors to use a simple ticker. And it integrates Bitcoin exposure into a traditional brokerage account. That is useful. But here's what IBIT does not solve. It does not solve volatility. It does not solve drawdowns. It does not solve regulatory uncertainty. It does not solve over-allocation. And it definitely does not solve emotional behavior. A beginner can still panic sell. A beginner can still buy from FOMO. A beginner can still put too much money into a volatile asset. So IBIT makes Bitcoin easier to access, but it does not make Bitcoin easy to hold. IBIT solves the access problem. It does not solve the investment risk problem. And the first major risk is volatility. Bitcoin is still volatile. That is the first risk every IBIT investor needs to accept. Bitcoin can rise sharply. It can also fall sharply. It can go through long drawdowns. It can spend years below previous highs, and it can test an investor's patience more than many traditional assets. Buying Bitcoin through an ETF does not magically smooth out the ride. IBIT can still behave like Bitcoin. That means investors should not buy IBIT just because it is easy to click the buy button. They need to ask whether they can emotionally handle large price swings. They need to ask whether the money is truly long-term money. And they need to ask whether the position size makes sense. Because if a normal market correction scares you, Bitcoin volatility may feel much worse. But volatility is not the only risk. There is also a fundamental difference between Bitcoin and assets that produce cash flow. Bitcoin does not generate cash flow. That makes it very different from many other investments. A stock can have earnings. A bond can pay coupons. A REIT can generate AFFO. A dividend ETF can distribute income from underlying companies. Bitcoin does not do that. There is no dividend, no coupon, no earnings report, no cash flow to analyze in the traditional way. That does not automatically make Bitcoin bad, but it does make valuation harder. The return depends mainly on future price, demand, scarcity narrative, adoption, liquidity, and investor behavior. That means Bitcoin can be powerful, but it can also be hard to value. And with Bitcoin, there is no cash flow to fall back on. So if the price falls, investors cannot rely on earnings or dividends to support the thesis. That is why structure and risk management matter even more. And with IBIT, structure is the next risk to understand. IBIT reduces complexity for the investor, but it does not remove every structural risk. There is still the trust structure, institutional custody, regulation, tracking, Bitcoin market risk, and possible tax or rule changes over time. The official material also makes clear that the trust is not registered as an investment company under the Investment Company Act of 1940. That is an important structural detail. For beginners, the simple point is this. IBIT may feel like a normal ETF inside your brokerage account,
but the underlying exposure is still Bitcoin, and the structure is not the same as a broad stock index fund. That does not mean investors should avoid it automatically. It means they should understand what they are buying. Simpler structure for the investor does not mean zero structural risk. And this is the kind of balanced crypto investing breakdown we focus on here. This is the kind of no-hype crypto breakdown we focus on at Boring Money Wins. Not pretending Bitcoin is risk-free, not dismissing it just because it is volatile, and not telling beginners to buy something they do not understand. The goal is simple investing education without hype, panic, or fake certainty. If this kind of breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want clear analysis instead of noise. Now that we understand what IBIT is, how it works, and what risks remain, let's make this practical. Who may actually like IBIT, and who should be careful? IBIT may appeal to beginners who want simple Bitcoin exposure. It may also appeal to investors who prefer using a traditional brokerage account instead of a crypto exchange. If someone does not want to manage self-custody, private keys, wallets, or on-chain transfers, IBIT may feel much easier. It may also fit investors who want a small crypto allocation inside a broader portfolio. But the key word is small. IBIT may be a tool for controlled Bitcoin exposure. It should not automatically become the center of someone's financial life. The investor still needs volatility tolerance. They still need a long-term plan. And they still need to understand that Bitcoin can move very differently from stocks, bonds, REITs, or dividend ETFs. IBIT may fit investors who want Bitcoin exposure without managing Bitcoin directly, but it is not right for everyone. So now let's talk about who should be careful. Some investors should be very careful with IBIT. If you are looking for income, IBIT is not built for that. If you want stability, Bitcoin exposure may not be the right tool. If you think ETF means safe, that is a dangerous misunderstanding. And if you are buying because of FOMO, you are probably not making a disciplined decision. And if you cannot handle deep drawdowns, Bitcoin exposure can become emotionally difficult. Investors should also avoid using short-term money. Money needed for bills, emergencies, rent, debt payments, or near-term goals should not be placed into a highly volatile Bitcoin product. Bitcoin exposure is not emergency fund exposure. IBIT can make access easier, but easier access can become dangerous when investors skip risk management. That is why the next question is not just whether IBIT is easy to buy, it is what job IBIT should have in a portfolio. IBIT should have a role in the portfolio. It should not become the whole portfolio. For some investors, IBIT may work as a small satellite allocation. That means the core of the portfolio may still be built around diversified assets like broad market ETFs, bonds, retirement accounts, or other long-term holdings. IBIT can then serve as a controlled crypto exposure tool. Investors may also use rebalancing discipline. That means if Bitcoin rises sharply and becomes too large in the portfolio, the investor has a plan. If Bitcoin falls sharply, the investor also has a plan. The goal is not to let FOMO decide the allocation, and it is not to confuse a Bitcoin ETF with a safe core holding. IBIT can be useful, but it needs a job, it needs limits, and it needs risk management. With that framework, we can bring everything together. So is IBIT the easiest way for beginners to buy Bitcoin in 2026? For many investors, yes. IBIT makes Bitcoin exposure much easier to access through a traditional brokerage account. It reduces the need for self-custody. It removes some of the technical friction around wallets, private keys, and crypto exchanges. And it can be simpler for beginners who want exposure without managing Bitcoin directly. But IBIT is not magic. It does not remove Bitcoin volatility. It does not create cash flow. It is not diversified. It is not a guaranteed return, and it should not be bought because of FOMO. The balanced answer is this. IBIT may be one of the easiest ways to buy Bitcoin exposure, but easy access does not replace risk management. The best crypto allocation is not the most exciting one. It is the one you can survive. That is the boring answer, and boring money usually wins because boring money usually survives.